So, what the hell was in today's consumer price numbers from December? Apparently, the bond market really loved it. We got a huge reaction in the Treasuries, as well as the rest of the bond market around the world. In fact, it was a bigger reaction in the Treasury market to this CPI than there was back in July when the June CPI numbers came out that were massively disinflationary. So, we've got to talk about what's happening in the bond market here, as well as what's in the CPI that may have caused that reaction. And it may not actually have been the CPI itself. There may be other reasons for what's happening with the big rally in treasuries, at least today. Some of it may be just be trading oversold. We'll talk about that, as well as where the fundamentals are, where treasuries in relation to other markets, so we can get a sense of how this sell-off has progressed and what it actually means going forward from here. But before we get to all that, though, we're going to have to take a look at what was in the CPI report that triggered such a rally, not just in the bond market, but also stocks too. Stocks absolutely soared as the market, stocks as well as bonds, the whole financial market is starting to digest that. Okay, maybe those fears that consumer prices were too sticky or worse, getting out of control again, in danger of going out of control. Maybe those were put to rest to a fair extent in what was in the consumer price numbers today. And that's one of the reasons why the bond market had such a huge reaction to the numbers. So we'll go over the key takeaways in the CPI as well as the PPI, which kind of set the table yesterday. Let's start with those. Let's start with the CPI. So we know what happened today. Then we'll talk about what happened in the bond market and try to make some sense of why. And the key takeaways, as I said, the PPI, producer prices yesterday kind of set the table, especially in the services part. The market, as well as even Federal Reserve officials and observers, are starting to get the sense and starting to realize that this disinflationary process does not go in a straight line. And the December CPI report just reinforced the fact that it goes up and down, up and down. And every time it goes up, you don't get too excited because eventually it's going to come back down again. A little bit of a mystery. I don't know what the hell happened in gasoline or motor fuel in CPI. For whatever reason, the BLS decided that gasoline prices or motor fuel prices absolutely soared in December when they really didn't. So that's part of the reason why the CPI overall was higher was the fact that motor fuel, according to BLS, jumped by 4%. Shelter prices, which a lot of people have been pointing to as a reason for the stickiness, they continue to break down, which predictable. That's what we expected to happen. But a lot of people said shelter prices were being sticky because of immigration and a whole bunch of other issues. Well, that's not the case. And we're seeing that more clearly as the data rolls in here as well. And we'll talk a little bit about the initial reactions from some Federal Reserve officials to the CPI report, as well as we'll get Tom Barkin's take on what he thinks is going on in the Treasury market and why he's completely wrong about that. So the question is, was the CPI data actually the reason for the big drive in Treasury markets? And let's start with the PPI because that's where it began yesterday. We had a relatively tame PPI month over month. You can see it's pretty steady and has been for the last year, which is a good thing. Steady PPI, steady producer prices, even though the year-over-year rate has jumped up to the highest in a couple of years. It just means that there's no building producer price pressures either. It's just kind of settled into a new equilibrium, which is what I talked about in yesterday's video here on YouTube. So even though the year-over-year rate is up to around 3.3%, which is the highest going back to the supply shock era itself a couple of years ago, it's really not. I mean, it's typical for producer prices. You can see back in 2018, producer prices got up to around a 3% annual rate. That's not really anything different than even the disinflationary 2010. So already producer prices suggesting the same thing. The good news as far as producer prices went was the core rate. The core rate actually did decelerate after a couple of high months. And you can see, again, the ups and downs that are just normal part of the process. So core consumer prices or core producer prices, consumer prices too, we'll get to those in a second. But core producer prices decelerating through the last couple of months up to December, which is good news there because a lot of people have focused on services. And the services part of the producer price index was the reason why the overall producer price index, and especially the core rate, were as tame as they were in the month of December. So allaying a lot of fears that producer prices or services prices, whether producer or consumer, are going to continue to contribute and even accelerate prices overall. So some good news on that front, or at least maybe not necessarily good news, but confirmation for those of you who are paying attention to how these things go. Consumer prices. Okay, the data we got today for the month of December, what you see is it's basically the same. We've gone through these multi-month periods all throughout the disinflationary period that started in the middle of 2022. And the fact that it started in the middle of 2022 shows you it's not the Fed. The Fed's rate hikes, assuming they even worked, they sure as hell wouldn't have worked that fast. So what happens is disinflation is not a continuous straight line process. And I think the fact that we've gone through this for like the fourth time now, it's starting to sink in that, okay, consumer prices are going to go through multi-month periods where they accelerate, then they calm down, then they accelerate again, then they calm down. And overall, what that does is confirm what I talked about yesterday, that the disinflationary process is still happening. And disinflation, the point of yesterday's video, doesn't mean what I think a lot of people in the public actually want it to mean. It doesn't mean that prices are going to go back to where they were because we underwent a phase shift during the supply shock. And sadly, we lost all that purchasing power and we're not going to get it back. So what we're talking about with disinflation and establishing that it's nonlinear, it goes in this discontinuous lumpy process. Disinflation simply means the supply shock, the phase shift is done. We're not going to see a reacceleration of consumer prices in any substantial long run way. We're kind of stuck in the new equilibrium and prices might continue to slow down, but this is basically what we're going to get here. The overall rates are going to go back lower to where they likely were in the 2010s, but we're not going to see prices collapse and drop back to where they were in the 2020s. We're seeing the established disinflationary process, which just simply means what caused purchasing power to be lost in the first place, that's in the past. That's the only good news here, unfortunately. So as far as consumer prices, you still see the ups and downs in the annual rate for the CPI. In fact, the annual rate for the December CPI was higher than both October and November, but that's not unusual either. You can see the CPI goes back and forth, even the annual rate, even around 3%. That's still relatively tame given where we are, where we're coming from. So again, more confirmation that we're not seeing things get out of control or spiral in a way that would cause the Fed to actually be hawkish this year. We'll get to the Fed in just a minute. Same thing with the core CPI. You can see the back and forth of the monthly rates goes in, it's a multi-month process. So it's understandable why people get excited about these multi-month periods where the monthly rate accelerates, but then it drops off for a couple months and accelerates again. And what you notice when you actually look at the data is that through all those ups and downs, the direction is still lower. It's just not as fast as maybe people imagine. It's certainly not as fast as would be ideal for consumers who are really struggling. But either way, it's more confirmation of the disinflationary process, even if it is not an ideal one. But it is consistent with the historical pattern. You take away food, energy, and shelter, so the rest of the CPI bucket, it's the same thing. Again, you see the same thing over and over and over again, repeating periods where prices accelerate in one part of the CPI bucket and then another part, and they never really get synchronized together, so you can get this nice, clean disinflationary trend that most people imagine when they hear the word disinflation. But when you take out shelter prices, and I'll get to shelter prices in just a second here, when you take out the imputation of shelter prices, most of the rest of the consumer prices are already solidly in disinflation. To the point that it's even below the Federal Reserve's target. Not that we should care about the target, but that's certainly a one way to compare consumer prices and how the progress is going, and certainly to try to get a sense of how the Federal Reserve is going to react, and therefore set its short-term monetary policies. But either way, you take out the shelter of the last couple of years, and we've been solidly disinflationary this entire time, which again just reinforces the notion, disinflation, the end of the supply shock. We're not seeing a restart of price pressures or the start of legitimate inflation. None of that is actually happening. It's just that it's not in a straight line. It's discontinuous, it's lumpy, but it is there and it has been there. And it's been there long enough that maybe the December CPI numbers were sufficient to finally get people to really grab onto this idea that it's not going to go in a straight line. This is what we're going to get. We're not going to see prices go down. We're not going to see negative CPI numbers unless things get really bad and out of control. We're not going to see that. We're just going to see consumer prices settle into this new equilibrium. And that's what all the data is showing, which in many ways, given what so many expectations were, that's actually a positive. Again, the motor fuel thing, I don't really know what happened there, but the fact that gasoline prices and the CPI spiked as much as they did during December, and yet the rest of the CPI numbers, including the headline number, weren't as bad as they might have been with that such a big increase in motor fuel, is actually another positive, saying that there's more disinflation throughout the rest of the consumer price experience. Then we get to shelter. Shelter has been a point of contention for a very long period of time because of the way it's made and what it actually represents. Most of shelter prices, they're not observable. There's some market-based shelter prices, but those are actually disinflationary, if not deflationary, even more. Most of shelter prices are just owner's equivalent rent, which is an imputation, and it's we don't need to get into it here, but it's basically, it follows housing prices with a lag of a year to 18 months, although in this case, it's actually closer to 2 years. The lag has been that much longer. But because shelter prices has seemed to remain sticky for a long period of time, a lot of people said that this was actual legitimate inflation and it was going to be a continuous problem on into the future. And some even hinted at that this was going to be the reason why consumer prices were going to continue to be sticky and even accelerate if you believe in expectations theory, which you should not. But under expectations theory, they thought this was going to be a basis for consumer prices overall to accelerate into the future. But what we've seen is exactly what we've expected, a slow shift in 2024 and likely into 2025, where even owner's equivalent rent, that imputation, is starting to slide and slow down and decelerate too. So even the parts of the CPI that appeared to be most sticky and the biggest problem spots are shown to be disinflationary, undergoing the same disinflationary process that we see throughout the consumer price bucket. So it wasn't so much that the overall CPI was it was really good. It was more so that it confirmed a lot of what people are now suspicious about, or at least it confirmed a lot of people are realizing that this entire disinflationary process of what it really is and what it actually means. And just by the way, all the details here, the producer prices, and a whole lot more. This is stuff that we go over in Eurodollar University's daily briefing. Every day we talk about the details of the major releases that come out. Yesterday, for example, we had the producer price numbers as well as the credit statistics from China, which were eye-opening. And then in the market summary that I put together with the daily briefing, I went over what's going on in the repo market, Shibor, as well as China's bond yields, and CNY, the currency, which was very close to the daily limit yesterday. So all the details on the macroeconomic and market stuff, that's in the daily briefing. Then we go even further than that in our deep dive analysis. But moving forward, okay, so the Fed's reaction to the CPI, because we have to care about the Fed since it's interfering with the future path of short-term interest rates, and it is playing a role on the curve, as I'll get to in a minute. Even before we got to the CPI, some Federal Reserve officials were already talking about what I just did with shelter prices. They were realizing that these imputations were distorting the overall picture of consumer prices in the real economy, singling out housing because that's the biggest one. It's a huge part of the CPI bucket, a big proportion, and it just doesn't fit with reality. Again, the market-based rents are nowhere near what the imputations are, and it's the lag to housing prices and owner's equivalent rent has extended for reasons that we'll probably never know. So even the Federal Reserve has come around to the idea that the imputations are just misleading, just as the imputations become less misleading and start to get with the disinflationary process all their own. So even before we got to the CPI, the Fed was already stating that, yeah, just like the payroll report, we're looking at some of these consumer price measures, and we're thinking they're overstating consumer prices to an extent too. And again, we're not talking about inflation. We're talking about price changes on a short-run basis. Again, as I said in yesterday's video, what people refer to as inflation is not what we're really talking about here. The inflation that they're referring to was the phase shift and the supply shock a couple of years ago. That's what the disinflation is showing, that the supply shock and the phase shift is over with. And even the Federal Reserve is starting to understand that's the case. And what the CPI report today really did was confirm that there aren't any signs of some even nascent resurgent consumer price pressures from some other part of the economy. So market-based shows that there's less consumer price growth than even the headline CPI does. And then the reaction to the CPI report today, I'll just highlight the Richmond Fed's Tom Barkin, because it was what he said was basically representative of the rest of the FOMC officials, those who have made comments like Goolsby, and I forget the other one. It doesn't really matter. They all sound the same. Barkin said that, the CPI data just confirms that for his perspective, and therefore likely the rest of the Federal Reserve's perspective, it confirms that everything seems to be on track, which then gets into trying to figure out what the Fed's interest rate policy will be from here. Are they going to be more hawkish? Are they going to be more careful, especially after the jobs report, the payroll report, the establishment survey part of it from last week? So does the CPI kind of erase that? Well, according to the market, it did. And Barkin was even asked about what has gone on in the Treasury market as far as yields backing up. And he blamed, because he has to, he blamed Treasury supply, even though there's no evidence Treasury supply has any impact on interest rates anywhere at any time. And I'll show you exactly what I mean in just a second here. But it's funny that he says it wasn't inflation expectations. And he also said it wasn't about confusion or uncertainty over the path of short-term interest rates, when all the evidence shows that's exactly what it is. It's the fact that the Federal Reserve hasn't been clear in all of its communications about what it actually expects to do next year. In fact, Jay Powell at his December press conference, what did he say? He said, we have no idea what's going to happen in 2025. Anything that we talk about here in 2024 will have no bearing on whether or not we cut rates in 2025. So the Fed has been, certainly out of all the rest of the central banks around the world, those at the Federal Reserve have been the least helpful in guiding the path of short-term interest rates and allowing the marketplace to set fundamentals based on that. So even here's Barkin saying, we didn't do any of that. This is just Treasury supply. That's the reason why yields are rising. But like I said, you can see that that's not the case. It really is uncertainty over the Fed that is really shaping what's happening in the bond market. But before we get to those fundamentals, though, there are a couple things that suggest the reason why we had such a major reaction to in the Treasury market to the CPI wasn't really the CPI numbers. The CPI numbers were not ultra convincing, but they were convincing enough that, as I said, it was reinforcing the notion that disinflation is still the main process. There isn't anything that suggests 1970s style reinflation anywhere, because that's not going to happen. It's not actually what inflation is. We're not seeing anything like that in inflation here at all, and haven't the entire time. So the December CPI reinforced the disinflationary process, that all of that stuff is in the past. We're going through this long, slow downside of the process, which doesn't happen in a straight line. So getting used to the fact that it doesn't happen all at once nor in a straight line, and it drags out through a long period of time, and it goes up and down along the way. The fact that that happens was taken positive because it allows the Fed to then take some of the upside to consumer prices the Fed is afraid of, that the market really isn't, take that off of the table and start coming around to more focus on actual economic weakness, certainly around the rest of the world, and how that might play out in the U.S. So the bond market moved today. Let's talk about some of the trading stuff that's gone on. The sell-off, I mean, a lot of people, you talk to traders, you listen, you go through social media, you get the sense that, yeah, a lot of traders have just been waiting for the sell-off to run its course and waiting to get back into the marketplace. The reaction of the Treasuries today to the CPI was, as I said in the intro here, it was even bigger than it had been in the July release of the June CPI. It was that time the 10-year Treasury yield fell about 8 basis points, whereas today it was down 12. The 10-year the last couple of days was flirting with 4.8%, and many people are saying it's gone its way to 5%. It backed down to around 464, and I think it closed around 466, or about to close at 466. So basically a dozen basis points or so in the 10-year Treasury, pretty strong move. And I think a lot of it from a trading perspective is a lot of those potential bond bulls have just been sitting on the sidelines while the sell-off continues time and time again. No reason to get back in, with the Federal Reserve being as unhelpful it is about the future path of short-term interest rates. It's just sitting here waiting for something to catalyze a reason to buy. And that's what we see in a lot of different ways. Bloomberg reported, I believe this was yesterday, how we've started to see a pileup in options as well as some other things. JP Morgan's survey on client positions. Clients are starting to get, JP Morgan's clients anyway, they're starting to get as bullish on bonds as they've been since last year, 2023, before the rally there. We got more people in that survey that are long bonds since the rally began back in 2023. And you can see that the long positions, or those who say they're long Treasury bonds, increases the farther the interest rate rises, because as a trader, what better if you're intermediate and long-term bullish on interest rates going down for a variety of potential reasons, what better way to make money than just sit back and wait for the sell-off to run its course? And I think that's what these numbers are saying, as well as the behavior in the Treasury market itself. We've also seen, as Bloomberg also reported, options activity that suggests some risk takers are taking additional risk in betting that the Federal Reserve will be even more dovish than the rest of the market, including cash treasuries, is right now. So you see some options taking, suggesting that the positioning for rate cuts to happen in the first half of the year, even though the market and the Federal Reserve right now, and the base case in the mainstream is that the Fed won't cut rates until the second half. And even then it'll only be a couple rate cuts, a couple 25s, nothing substantial. The markets, you keep going back and forth. The sell-off in Treasury rates since September, all of that stuff. We may be entering the period where the bond market got oversold. Fundamentals are aligning in that direction. Traders are starting to get the sense that the sell-off got to be too far, starting to take some risk again on bonds going to the upside in price, downside in yield. And today's CPI certainly would be a catalyst, as when seen as more confirmation that there isn't that upside risk in inflation that everybody's been talking about. Fundamentally, though, Treasury yields have been on the upswing because of the Fed, and largely because of the Fed. And the other reason is that the curve itself is uninverting and steepening. So it's not unusual for that uninversion process. We'll start there. The uninversion process to look like this. Bull steepening, we use the term bull steepening. It's sort of a catch-all too. You say bull steepening, and I've done this repeatedly too. You say bull steepening, it means that interest rates go down, and you think, well, the long end goes down and the short end goes down farther and faster, and that's how it works. But it's not one thing or another. Bull steepening can take many different forms, and it's a dynamic process. And what we've seen in almost every cycle, in fact, I think we have seen in every cycle, short-term rates go down. When they start going down, we see periods where the uninversion means that short-term rates go down, but long-term rates actually back up, and for not just a little bit here or there, but for multi-month periods. So you can see the long end go up at the same time short rates go down, and that's the initial phase of uninversion. That's exactly what we've got going on here. Plus, you throw on top of that, contrary to what Barkin was saying, the fact that the Federal Reserve itself refuses to be clear on what it's seeing because it really doesn't know. Let's be honest. The reason why the Fed won't commit to a number of rate cuts or the path of short-term interest rates, because they have no idea. They're waiting for the next CPI, the next jobs report, then the next CPI, the next jobs report. They're responding to data as it comes in rather than forecasting correctly based on some insight into how the economy is actually evolving. So you put these two things together in the Treasury market, you've got the historical pattern of uninversion and bull steepening together with increasing uncertainty about the Federal Reserve, and it's a recipe for a sell-off, plus the speculators and traders who are sitting back thinking, I'll just wait for bonds to cheapen themselves enough to make it worth the while to jump in and take some risk. And the reason we can tell that the Fed is really the biggest problem here, other than the uninversion in the curve, is just by comparing the U.S. Treasury market to other markets around the world. And you can see that most of these markets, it's a globally synchronized bond market. It's not a Treasury market. It's not a Canadian market. It's not a German market, as I'll get to in a second. It's a globally synchronized market. And so when we see any divergences, it tells us pretty quickly what those divergences must be. And in this case, when we compare Canadian interest rates to U.S. Treasury rates, and it doesn't matter what spot on the curve, I'll get to the 2 years in just a second, what you see is the difference there is entirely the difference between the Federal Reserve and the Bank of Canada. So the Treasury yields go up and down in the short run, pretty much synchronized, and then over a certain period of time, over the intermediate term, they diverge because the Fed and the Bank of Canada have diverged. That has absolutely nothing to do with the supply of treasuries versus the supply of Canadian government bonds. Those two things are very different, yet we see a synchronized behavior of interest rates, which means what's going on here is basically the difference, the starting point, first of all, in short-term interest rates where the Fed and Bank of Canada are, but also that uncertainty about the future path of short-term interest rates. The uncertainty is much, much higher for treasuries to deal with the Federal Reserve than it is in Canada. And this is something that you could see Not the first time this has happened in these markets, in the global bond market. You see same exact thing back in 2017 and 2018, when, just like now, the Federal Reserve hiked rates farther and was far more uncertain with its rate hikes in 2018 than the Bank of Canada was. In fact, at the end of throughout 2018 to 2019, the difference was about 75 basis points. The Fed had hiked 75 basis points above the Bank of Canada and was still threatening to hike even more into 2019 before finally they got mugged by reality, which the Bank of Canada saw more clearly than the Fed does. And we're repeating that same exact cycle here, or the same exact pattern here. Like I said, you can see it more clearly in the 2 years. The 2 year, both rates are going down, but the higher degree of uncertainty about the Fed means that there's now a difference in between the Treasury 2 year and the Canadian 2 year. And it was the same thing, the Fed hike, creating greater uncertainty compared to the Bank of Canada. Same going back to 2018. Fed hiked much farther, more uncertainty. The 2 year Treasury got much higher than the 2 year Canadian. It's basically the same thing. So Barkin was wrong about that. And we can even see the same thing in German yields. Treasury rates are going up much farther relative to German counterparts. And even though we have overall synchronized behavior between treasuries and Germany, again, that eliminates the prospect of treasury supply being any factor here, because the fiscal situation of the federal government in the United States is night and day different to the one in Germany. Yet German interest rates are backing up too, just not nearly as much as the Fed's are. And the reason why German rates are backing up is because that's the part that I said previously. That's the part where the curve is uninverting and steepening. So even though Europe's in much worse shape, especially Germany, the data that came out today that I went over in today's daily briefing, the data came out today in Germany just reinforces the notion that Germany's economic fundamentals are far worse. And yet German long-term interest rates are rising anyway, because that's, as I keep saying, the process of uninverting and bull steepening. But it's much greater in treasuries because of Jay Powell, Tom Barkin, and all of the rest of them. And again, we saw the same thing back in 2017 and 18 when the ECB held rates at zero that entire time, and the Federal Reserve was hiking up until 2019. So the reason why the Treasury market had sold off to begin with was because of lack of clarity from the Federal Reserve, which, bringing us back to the original part of the discussion, the CPI itself was not really all that remarkable, except for that it further reinforces the fact that the U.S. economy is not seeing some new inflationary pressures that are developing, either legitimate inflation or something else from someone's imagination at the Fed. It really cleared up and reinforced the notion that we're still experiencing the same back and forth, nothing different that we haven't seen over the last couple of years. And because of that, that might provide a window for the Fed to clear up its plans for next year, at least, to eliminate some of the high side for consumer prices that people were afraid of. And because of that, with so many people, so many bond bulls waiting on the sideline for bonds to cheapen themselves, you got the big reaction in treasuries today for reasons that, the CPI all alone, just taken in isolation, just wouldn't have explained. Like I said, it's basic. We're seeing the same thing happen all over again. The difference is the Fed. And one last fundamental piece here that I do want to point out. I always like to start with interest rate swaps, especially longer dated swaps, because what they're really saying is that the direction for interest rates over the long term continues to be down. You see only a very modest interruption in that trend, over the short run trend, going back to really July and August, really back to that June CPI in July. Even the Trump trade, only given a little bit of a consideration and some volatility in the 30-year swap spread. But overall, swap spread continues to go down. So even if Jay Powell is confused about inflation and direction of the economy, the swap market, it's not perfect. It's not a crystal ball, but balance of probabilities, that's the direction that interest rates are going to take over the long run, which simply means they're going to go down probably a lot more and likely to stay there over the long run. And that has not changed despite the short run fluctuations in the Treasury market for all of these various reasons. So just bringing this back to the beginning here, the Treasury market was responding to a couple of things, but really not about today's CPI, but just more confirmation that everything that we think is happening really is happening. And then the trading conditions on top of it, on top of the actual fundamentals, what the foreign comparisons and interest rate swaps and everything else tell us about the underlying baseline for where interest rates are likely to go, even if we can't figure out how the Federal Reserve might get there in the short run. But even the CPI, what it really did is it kind of clears up the fact that even though the Fed doesn't know where it's going or how it's going to get there, it's going to eventually get there. That's what the balance of probabilities show. And so that's why you got the big reaction in the Treasury markets. It started with the PPI. All the details in the CPI show exactly the same thing, which is that disinflation, not what most people think of when they think of disinflation. Inflation itself is not what most people think of. And this disinflationary process, even though it's not what we really need it to be, which would be prices going back to where they were, it is still recognition. It is still confirmation that all of the nightmare of the last couple of years, that part of it's over. But that just means that we have to deal with the consequences of everything, which is a topic that we'll get into many, many times here in YouTube. And I've already gotten into a lot at Eurodollar University. So check out Eurodollar University's daily briefing, the deep dive analysis, the memberships, where I just put up the series on interest rate swaps. That's available too. All at our website, eurodollar.university. And with that, that's the CPI report and the Treasury reaction to